The stock price for Merck Co. Inc., trading under the ticker MRK, is currently sitting at $90.95, reflecting a significant intraday gain of $4.20 or 4.84% as of late morning trading on November 12, 2025. This decisive move upward immediately challenges the prevailing skepticism that has been hanging over the pharmaceutical giant, particularly the concern about the longevity of its primary oncology driver. The general market narrative has positioned Merck stock as one of the big pharma companies facing an inevitable and painful patent cliff for its flagship cancer therapy. But this large price jump on a Tuesday morning suggests something deeper is at play, demanding a closer look beyond just the fear of Keytruda's eventual loss of exclusivity. We're seeing a sudden repricing of Merck's pipeline assets, which is the immediate insight that should hook any investor watching the tape. While everyone focuses on the 2028 patent expiration and the potential impact of government drug price negotiations, the immediate reality, supported by this recent price action, is that Merck is executing on its strategy to build what is increasingly looking like a formidable wall of new, substantial revenue streams to manage that drop-off, something that most investors, distracted by the specter of the patent expiration, have fundamentally underestimated. The narrative of an impending downfall is clashing with the on-the-ground performance of new medicines. The common understanding of Merck centers almost entirely on Keytruda, the multi-billion-dollar anti-PD-1 therapy that has become the bedrock of the company's financial results, making up nearly half of their total pharmaceutical sales. The market expectation is simple. A heavy reliance on a single asset makes the company vulnerable. And as the 2028 patent expiration date and potential government price setting in 2026 draw closer, a gradual but steady decline in Merck's stock is the most rational forecast. This belief is what has capped the stock's upside movement for much of 2025, keeping it trading in a relatively tight range. However, this expectation fails to fully account for the velocity and size of the recent positive clinical trial data, which the market appears to be scrambling to integrate today. The reality is that the new pipeline assets, especially the investigational oral PCSK9 inhibitor enlicitide decanoate, are showing efficacy data that could significantly alter the company's future revenue mix years before Keytruda's major sales decline truly hits. The latest Phase 3 results for enlicitide decanoate in multiple lipid trials showed a statistically significant and clinically meaningful reduction in LDL-C, or bad cholesterol, reductions that are turning heads in the cardiovascular community and now clearly on Wall Street. This asset, along with the recently launched pulmonary hypertension treatment Winrevair, which saw a tremendous 141% sales increase in the last reported quarter, is establishing a much-needed diversification away from just oncology, creating a tension where the expectation of an oncology-driven downturn is being met with the reality of a multi-pronged therapeutic resurgence. This robust performance of new compounds is what should truly matter for those engaged in online investing. Looking closely at the recent stock movement, the current volume is elevated, indicating that this is more than just a momentary blip. Institutional participants are moving in, likely reacting to the cumulative positive news flow that has been building since the Q3 earnings report. Merck reported adjusted earnings per share of $2.58 on October 30th, which beat the consensus estimate of $2.35, on revenue of $17.3 billion, also a beat. Ordinarily, an earnings beat of this size would cause a jump, but the stock initially saw a slight dip because the market fixated on the slightly weaker than expected growth rate for Keytruda, along with a narrowing of the full-year sales guidance. This is a perfect example of the expectation versus reality gap. The market expected flawless Keytruda growth, and the slightest disappointment overshadowed a fundamentally strong quarter and, critically, strong performance from new products. Winrevair sales were a particular bright spot, generating $360 million and underscoring the success of their business development activities. This current 4.84% jump suggests that smart online investment funds and sophisticated individual brokerage accounts have had time to digest the full earnings call transcript and the subsequent positive clinical data, and they are now realizing the full growth profile offered by this new roster of drugs is worth a premium that the stock has been denied. The focus has decisively shifted from the modest Keytruda growth miss to the multi-billion-dollar potential of the non-oncology pipeline. This reevaluation of Merck's future prospects is a must-watch for anyone doing self-investing. In terms of institutional activity, the last reported filings show a mixed picture, which is typical for a major pharmaceutical stock that is navigating a patent challenge. We've seen some large institutional holders like Vanguard and BlackRock trimming their positions, albeit slightly, in the most recent quarter. However, what is equally important is the activity of firms like JPMorgan Chase & Co., which reported a significant increase in their position. This division in activity highlights the fundamental debate. One side is de-risking against the patent cliff, the expectation of risk, and the other is taking advantage of what they see as a discounted valuation relative to the pipeline's growth potential, the reality of opportunity. It's a tug of war where the current 4.84% gain suggests the pro-pipeline camp is currently winning the battle. This kind of back-and-forth movement is a crucial data point for anyone engaged in self-investing or using platforms like Robinhood or Fidelity to manage their portfolios. It indicates the stock is in an accumulation phase driven by a change in fundamental perception, not just a fleeting technical bounce. This is a crucial distinction, and sophisticated investors on platforms like Interactive Brokers are acutely aware of these shifts in sentiment. The sustained high trading volume today backs up the idea that major institutions are making a clear statement about Merck's valuation. Furthermore, the company's ability to generate significant investment cash flow allows it to pursue disciplined, science-driven business development, evidenced by the recent financing agreement with Blackstone Life Sciences for its next-generation oncology ADC, sacituzumab tiromodekin. The core business model for Merck is built on research-intensive pharmaceuticals and vaccines, a traditional investment approach centered on intellectual property and high-margin products. Historically, the company has been a powerhouse, delivering consistent, albeit slow growth through a robust portfolio that includes not just Keytruda and Gardasil, the highly successful human papillomavirus vaccine, but also older medications for diabetes and cardiovascular disease, and a strong animal health division. Gardasil sales, however, have recently faced headwinds, particularly in China, a key market, though this is expected to be a temporary issue that is often factored into conservative estimates used by Fidelity Investments. The company has a long history of paying a stable dividend, making it a staple for many Fidelity mutual funds, and a frequent component of conservative approaches like Schwab Intelligent Portfolios and other platforms on various investing sites. The true long-term performance prior to the Keytruda dominance was one of stability. Since Keytruda took off, the stock's performance became almost inextricably linked to the drug's continued success and the timeline of its eventual competition. This historical context is vital to understand the current tension. For decades, Merck was a stable anchor, and the current volatility is largely a function of managing a transition from one high-growth cycle to the next. The management team has successfully navigated such transitions before, but the scale of Keytruda's revenue makes this particular challenge unique and requires significant execution across multiple therapeutic areas. The market needs to see that execution, and the recent clinical data is the clearest proof yet. Looking forward, the future outlook for Merck stock is a classic story of risk management versus reward capture. The risk is clear. The the stock price could be severely impacted if Keytruda's loss of exclusivity in 2028 is not offset by new growth. The Inflation Reduction Act's provision for government price setting, which Merck expects Keytruda to be subject to in 2026 for effective pricing in 2028, is a near-term headwind that cannot be ignored. The potential for a significant price reduction on its top-selling drug is the primary reason for the lingering skepticism and the reason the stock has traded at a depressed multiple. However, the opportunities are now much clearer, fueled by the data that drove today's pop, and this is where the reality of the situation diverges most significantly from the market expectation. First, the subcutaneous formulation of Keytruda, often referred to as Keytruda QLEX, has received regulatory approval. This formulation, which can be injected in a minute versus a lengthy IV infusion, is a classic life cycle management strategy designed to protect market share and provide a patient-friendly option that could slow the adoption of biosimilars after the patent expires. This is a critical defensive play